Alright, so the reason that you clicked on this video is probably the same reason that I started researching this very topic a few days ago. Tax season is coming up and you're struggling to plan your taxes. What I specifically wanted to know though is what's the best, most cost-efficient way for a business owner to declare income in 2022? I found that there's a surprising lack of information available on the internet about how to optimize this, for obvious reasons. Most accountants and accounting software companies make the largest share of their revenue through providing this kind of information, so they don't want to share it publicly. But at the risk of getting attacked by a horde of angry bookkeepers and tax planners, I decided to make this video because the information could be really useful. It was for me, and because it's my objective to help you grow your wealth, and minimizing your tax bill could play a big part in that. I want to preface this video by saying that I am not an accountant, and that what I'm about to say should not be construed as financial advice. I'm just a guy with multiple businesses and multiple income streams who was confused as hell about how to minimize my tax burden and wanted to protect as much of my wealth from confiscation as possible. So before you implement any of these strategies, make sure you talk to your tax professional and seek accredited financial advice. With that being said, let's begin. The options that I thought of initially are fairly straightforward. First, pay myself as an employee of the company and deduct that salary from the net income of the business. 2, pay myself in after-tax dividends from the company. Or 3, get a job working for someone else and get paid as a regular employee, taking as many deductions as are available to me. Here's the thing. There are many costs associated with owning and operating a business, and it's difficult for many people to work for their own company. So if you don't want to put in the effort to incorporate, or you think it's not possible for you to stop being an employee of someone else's business, it's probably best if you just stop watching the video now, because there's nothing useful for you to follow. Still here? Okay, great. Unfortunately, there's more bad news. I'm going to be honest with you. While whether to be an employee or a dividend receiving shareholder sounds like a trivial question, and that answer should be obvious, there are a few key issues that make this way more complicated than it seems. Let's completely ignore those for now and get right to the result for all of you who've been patiently waiting. If you own a small business, think a company that makes less than $500K per year in Canada, is it better to receive dividends or to pay yourself as an employee? Well, it's complicated. What a useless answer that is. Dislike. I'm sure that's what you're saying to yourself right now. Well, wait. I promise this gets better, but we have to get through the complicated stuff first. Here's some of the factors that you have to consider. What province do you live in? Do you have a mortgage? What's your mortgage rate and annual payment? Do you have a spouse? Are they about to go on maternity leave for spousal income splitting? Do you have a child on the way? How much income or revenue does your business have? What expenses can you reasonably justify as business expenses? What are your annual RRSP contributions? Do you have any other tax credits available? And there's way more than this. These are just the ones that I thought of off the top of my head. Luckily, I've made a spreadsheet that you can use and plug in the information above along with your provincial tax rates and calculate which option is better for you. Of course, this isn't all-encompassing and it's for informational purposes only. It may be completely wrong and ignore something critical. For me, I used it to determine whether it was better for me to become an employee or to remain a business owner and pay myself through dividends. But why would I want to do that? Put simply, it's to get a lower mortgage rate. Because I'm a business owner, the mortgage rate that we qualified for is higher than it would have been if I were just a paid employee of someone else's business making the same amount every year. Apparently, banks like to work with the government and only want to provide a good rate if you're paying a lot of income tax. So what does this look like? Let's pull up my spreadsheet and find out. Now, this spreadsheet is available to all of my Patreon subscribers. Join me there if you'd like to access it yourself. The link is down in the description below. All right, so here we go. The first sheet here is looking at our personal tax rates and understanding the federal tax rates and the tax rates in your province will be. So I have the personal tax rates, and depending on your income, you can pay anywhere from 15% to 33% marginal tax rate. Then you have your provincial tax rates. So you've got a minimum in British Columbia of 5% if you make under $42,000 a year, and up to 17% if you make over $222,000 per year. Let's take a look here and see what happens for someone who makes $200,000 a year. So basically you have RSP deductions. That's based on your prior year contributions. You have any contributions you make to charity, And then you have the spousal transfer section, which I'll talk about a little bit more later on. After your deductions, you have net personal income. Then the spreadsheet kind of looks at your income after deductions. So I have $114,000 worth of deductions here with the $85,000 personal income after deductions. Then you figure out your federal taxes payable, your total taxes payable, your BC taxes payable. There's a lot of taxes here. And your total personal income tax payable. Now, if you include your spouse in this calculation, we can actually see that your spouse's gross income is accounted for here, as well as the spousal transfer. So I've included the total spousal income tax payable because if you're married, obviously you want to know what your income plus the income of your spouse is going to look like and what your total tax burden is. If you're transferring all the money to your spouse and then they have to pay all your taxes, then that doesn't really help you. So basically, we're looking at a total income tax payable of $40,665. So that's quite a bit given a $200,000 income. That's like almost a quarter of everything that comes in, and that's just on income tax. Now let's look at the corporate option. Pretty similar here, but first we have to deduct corporate taxes. So we've got a federal rate of 9% and a BC small business tax rate of 11%. Gross corporate income, the same amount, $200,000. A salary that we've taken out and business expenses. So your corporate income after deductions is pretty low because you have a lot of business expenses. Obviously, you can adjust this based on how much you paid in terms of business expenses. So here we've calculated a minimum salary required, and that's based on some of our expenses plus the mortgage rate. Basically, we have a gross personal income, which is your corporate income subtracting out business expenses and corporate income tax, because you can't pay yourself your corporate income tax because you no longer have that money available to pay yourself with. Then we move on. We've got the same exact calculation here with your personal tax rates and your business tax rates. What we understand is that after deductions, we're looking at a personal income of about $35,000 and your total federal taxes and BC taxes available $7,088.26. So that's a lot lower. Even when you include your couple's income tax together, you're looking at about $14,500, which is substantially lower than the $40,000 that was paid before. But here's the rub. Now we go into the mortgage rate calculation, and we want to include our mortgage payment in this calculation, because if our mortgage payment is going to be substantially higher and it makes up for all the difference, then why would we not just be an employee? Here is a mortgage rate. This is approximately the spread that you get from having a corporate mortgage with a so-called B lender to an A lender, where you can get a variable rate of about 1.2%. Obviously, that's gone up now. I think it's about 1.7% on a 30-year mortgage, with the Bank of Canada raising interest rates. So with a $1 million mortgage loan amount, we're looking at $48,000 a year in payments if you have the 2.59%, and $39,000 if you have the best variable rate. In terms of total taxes or total paid, including your mortgage and taxes, we're looking at $62,858 per year if you're incorporated and paying yourself as an employee and taking all those deductions, versus $80,555 per year if you're just an employee of another company. A simple subtraction here can tell us that there's about a $18,000 difference between these two. Now, I mentioned dividends earlier on. So where do dividends come in? Okay, well, I have a website here that does the calculations for us, and I'm going to share this down in the description below if you want to use it yourself, but I'll bring it up on screen here so we can take a look at what the website says. So from taxtips.ca, you're able to use this calculator, and it'll help you determine for whichever tax year you want. Obviously, we're in the tax year 2021 right now because that was last year. It'll help you determine whether your dividends are going to be a lower tax rate compared to income. And then you actually take this and you factor it into your overall calculation and see if you're taking corporate dividends plus income, what that's going to look like, or if you're taking personal taxes. Say we have an employment or actual other income of $200,000. So in BC, we're looking at an average tax rate of 32.5%, which is pretty crazy. If we're looking at non-eligible dividends, it's actually going to be 40.4%. You're actually going to be paying more if you are looking at paying your taxes via dividends versus being an employee of your company if you're making $200,000 a year as an employee. Let's just check that here. So these will be non-eligible dividends because they're coming from a company that's making less than $500,000 a year. $200,000, yep, as we see here, it's on your next $100 of income. So that's your marginal rate. So overall, it works out to be lower. So obviously you can punch in your numbers. Your results may vary, but you can calculate whether it's better for you to go with dividends or whether it's better to pay yourself as an employee or whether it's better to work for someone else. So here's the answer you've all been waiting for. For me at least, it's way better to pay myself through my company, deducting relevant business expenses, and claiming my income as dividends. Even if I made 20% more as an employee of some other company, the taxes would more than overwhelm the additional income. Obviously, your results may vary, but the reality is that owning and running your business can have important and significant tax advantages. It's too bad that not everyone has the risk appetite to go out on their own. In my opinion, job security is mostly an illusion anyway in 2022, and if you're a high performer, there is a limited upside to being an employee. Of course, if you're saving all this money, it's important to know where to put it. Check out this video, and I'll show you which asset classes to avoid and which to invest in 2022. For now, that's all. We'll talk to you in the next one. Peace.